Welcome back to the channel. Today we're talking about one of India's most well-known manufacturing powerhouses, Dixon Technologies. The stock is trading near 11,800 after a sharp correction from its highs. So the big question investors are asking now is simple. Is this fall a warning sign or a long-term buying opportunity? Let's decode that clearly. Dixon operates in the electronics manufacturing services, or EMS space. It manufactures products for leading Indian and global brands under the Make in India and PLI programs. Over the last few years, it has become India's largest contract manufacturer across categories like mobile phones and wearables, LED TVs, lighting products, and home appliances. The company's biggest growth engine lately has been mobile manufacturing, supported by government incentives and import substitution. But remember, Dixon is not an electronics brand. It's a contract manufacturer. That means high volumes, thin margins, and strong dependence on execution. In other words, it's a scale game. Profits grow when capacity utilization improves. Now let's look at the numbers. The stock has corrected over the past year, pulling valuations down a bit, but it still commands a premium. Revenue growth has been robust, driven by new product lines, fresh client additions, and expanding capacities under the PLI scheme. Margins remain low but stable, as typical for EMS players, and debt levels are comfortable. The company keeps investing actively in new plants and automation, which is capital-intensive but builds long-term capacity strength. Fundamentally, this remains a volume-driven compounding story, not a margin-led one. Let's talk about why investors still like Dixon. 1. It's the clear market leader in India's EMS space. 2. It's a direct beneficiary of Make in India and the global China Plus One trend. 3. Long-term contracts with top brands provide predictable revenue. 4. Improving operating leverage can boost profitability once utilization rises. These are real structural tailwinds that keep Dixon's long-term story strong. But now to the other side, risks and valuation. Even after a correction, the stock trades at premium multiples for a manufacturing company. Since margins are thin, any disruption, like a slow project ramp-up, client loss, or a policy tweak in the PLI scheme, can hit earnings quickly. Working capital requirements are also heavy, which puts pressure on short-term cash flows. And being a high-beta stock, Dixon can react sharply to quarterly results, both up and down. Technically, the stock is consolidating around 11,800. Support lies in the 11,500, 11,900 zone, while resistance is near 13,000 to 13,500. Unless it breaks above that resistance with strong volume, price action may stay sideways for a while as the market digests fundamentals. So what's the strategy? For short-term traders, avoid guessing bottoms. Wait for a decisive breakout above 13,500 with volume before taking fresh positions. For long-term investors, this is a high-quality, structural, Make in India play. But valuation discipline matters. The better strategy is gradual accumulation on dips during corrections with a patient 1 to 3 year horizon. Keep tracking execution quality, margins, and policy continuity. The final takeaway: Dixon Technologies is a world-class manufacturer aligned with India's electronics growth story. But great companies aren't always great buys at any price. After the correction, the risk-reward has improved. Yet only patient, disciplined investors will truly benefit. If you found this breakdown useful, like the video, subscribe for more calm, data-backed stock analysis, and tell me in the comments, would you buy Dixon at these levels or wait for more clarity?